What is a plan for, let's say a first-time home buyer, someone that's never owned a home?
The first thing that I would say is that you don't need to have 20% down.
Thank God Brian said it.
Are you sure?
Figure out where your down payment is going to be first. What is your goal on that? Do I think in the next 12 months I can save more than 3 to 5%? Great.
Welcome back to Young Money Mindset, hosted by Luke Cariccia and Robbie Holdcross. From the ground up, where we talk about mindset, real estate, the hustle, and everything to help you achieve your dreams.
All right, guys, welcome back to Young Money Mindset. We got a really exciting episode for you folks today, switching up really the whole pace of our show and bringing on a lender to hopefully give us some expertise on the lending side. So I'm super, super excited for that. Grateful to have Brian Iverson here on the podcast. He is the co-owner of MyCityLending. And we're super excited to have you on, Brian. Thank you so much for coming in.
This is awesome, guys. Thank you, Luke. Appreciate you guys having me. Am I the first loan officer you've had on the show?
Yes.
Yeah. So that's why a lot of the times it ends up being investors or big realtors, things like that. So we wanted to get a glimpse into it because I get a lot of questions, obviously being on the traditional side of, just specific lending questions. So we figured we can kind of open up the conversation here today and just see what insight you could bring to our viewers.
Totally.
I've got a ton of questions for you. We'll see what we can get through. One of them's kind of a generic question, but it's a question I probably get asked the most, especially right now. I've had a ton of clients that are reaching out to me and saying, "Hey, Robbie, when do I know when it's time to refinance?" So I know some of the mortgage brokers I've worked with have started to tell me, hey, a lot of your clients that are maybe in the 7s, it might be getting around that time to when it makes sense to refinance. I'm curious from your point of view, with the cost involved in a refi and where rates are at currently, how would you answer that question?
I would start off by saying it depends. So, right. Everybody's situation is different. Everybody's circumstances, financial needs or goals are all different. If we're talking about, I'm just looking to save money on my monthly payment. That's my only goal. I don't have any debt to consolidate. I'm not trying to maybe pull some money out to invest in other real estate. Like if it's just I'm trying to lower my payment, the rule of thumb is you want to see maybe a point reduction on the note rate. You have to do the math and weigh the cost versus what is the monthly benefit. How long am I likely to live in this house? The answer is different if you're thinking like this is maybe another year or two and I'm going to be gone. I'm going to move on to some other house. You might not want to look at refinancing right away because you're gonna sell anyway, and the cost you're not going to make that up in your monthly payment depending on where rates are. So it really requires a careful calculation for every single customer.
What is the average cost for a refi right now?
The average cost? Well, I'm not quite sure to answer that. With regard to our company, we don't charge processing or underwriting fees. So the cost, if there is one, is going to be points if they want to buy the rate down even further. Again, you have to look at that very, very carefully. If you're not going to be in your house very long, it might not make sense to spend 2% of your loan amount to buy the rate down and save $30-$40 a month because you're not going to see that back.
It'll take forever to catch up. Right?
Yeah. But the cost is very different depending on the customer. Again, from our perspective, like we don't charge processing and underwriting. So the cost is going to be really what's the rate that we're able to offer them and are they looking to buy it down?
Right. Yeah. You mentioned something else there too that I get a lot of questions about, which is discount points, which I know they teach you in real estate school that it costs 1%, but I know that's really not true. It's a little bit more than an actual percentage, right, for a discount point?
The discount point, it's a percent. So it's a percent of the loan amount. So if you have a $400,000 loan and you're buying it down, generally the general rule is that for every percent you pay to buy the rate down, you're buying it down by about 0.25%. That might be what you're thinking of. Okay. So the point is the point. So if it's a $400,000 loan, 1 point is $4,000.
Right.
That might buy it down 0.25. It might buy it down 0.23 in the pricing.
I think that's the misconception that I see. A lot of times people think that the $4,000 is going to get you that full point.
No. A 1% of the loan amount generally gets you about 0.25 point lower on the
that's interesting. That's really not a whole heck of a lot. So
well, again, you do the math on it and you have to do it's an ROI kind of conversation. Like, does this make sense for you to do it? Are you living in your house? Is this a 20-year house or is this a 3-year house.
Well, and I love the way you answered that, Brian, because, a lot of our audience out there that, maybe is a younger type of person, or, maybe they've lived in their home for a while, but they've accumulated some other debt. Maybe it's either credit card debt or, car debt, and they're trying to consolidate that.
Yep.
Then you got to factor that into your calculation. You need to really make sure that, it probably would make sense. If you're going from a 21% credit card that you've been struggling to pay off, and you got a lot of equity in your house, but you see these headlines, of how scary these rates are right now, and you've been holding off, and you got maybe a decent rate, but you have a lot of other debt that you're paying, super high interest on. Make sure you guys are getting with a reputable, especially mortgage broker. I think that's another big misconception, or just a nuance that people don't realize when they're reaching out and speaking about this kind of stuff, is they try to call Chase Bank or Wells Fargo or something and get a mortgage, or, look at rates, when in reality you should be getting with, Brian here with MyCityLender, or, another mortgage broker, and really kind of getting into the weeds of, what makes sense, where can we shop this, does it make sense to purchase right now, or refi right now, or does it make sense to wait? So I also had another just quick side note and question on that. I have some clients out there, I'm sure that'll be watching this, that they want to get set up on a plan, right? They always come to me and they're like, Luke, I'm working on my credit. I've worked in my job for X amount of years. Like, what would your advice be, for me to really get on a plan to purchase a home here in the next 12 months? So my question to you, Brian, is what is a plan for, let's say a first-time home buyer, someone that's never owned a home, and that maybe has like a mid 600 credit score? Would you say there's a certain dollar figure they need to save? Should there be a percentage they're looking at? Just kind of walk me through that. What would you recommend?
The first thing that I would say is that you don't need to have 20% down.
Thank God Brian said it.
Are you sure?
The general limits today are 3% if it's a conventional loan, 3.5% FHA, 0 if you're a veteran, by the way. And I love doing VA loans. I think it's one of the good things that our government actually does on behalf of our veterans.
Yeah, and you guys heard that right. That's 0% on a VA loan.
I've done quite a few of them. It's an awesome
It's
tool.
0% down. It's no monthly mortgage insurance, even at 0% down. So it's a phenomenal deal. Figure out where your down payment is going to be first. What is your goal on that? Do I think in the next 12 months I can save more than 3 to 5%? Great. Go for 10%. At 10%, your mortgage insurance is way lower compared to 3 to 5% down. But you got to give yourself a margin too. Like this is what my down payment goal is, but nobody ever walks through their front door and doesn't look around and go, we're going to need a couch over there. We're going to need to paint this wall. We got to totally redo that. I want to put a bar there. I mean, nobody has ever walked through the door and not gone through this, and then moving expense and everything else. So build yourself a margin. So figure 3 to 5% minimum on the down payment, and then figure another couple of percentage points at least to be able to comfortably move in and at least get the house going in the right direction for you. You have to get with the lender early. Especially if you're a first-time buyer. It's okay to get with them 9 months, 12 months ahead. They can help you understand where you're at with your credit. They can do a detailed estimate on what your payment might be so that you can plan for that. I mean, right now, I think, and correct me if I'm wrong, but rental rates are a bit lower than mortgage payments right now.
Yeah,
right? So
a little bit.
I'm going off topic here, and not quite answering your question, but when we got started in real estate, my wife and I, it was in 2002. And we went from a beautiful Mark Taylor 2-bedroom apartment, $980 a month. It was over by the Chandler Mall. And we bought our first house in 2002 for $177,000. That same house today is about $600,000, by the way.
Yeah.
And we were taking our payment from $980 a month to about $1,500 a month. And that was there was a lot of payment shock there. So knowing that in advance and being able to, conceptualize that in terms of where you're at in your income, where am I going in my career, that's important. So
it is. It's really important. And Brian isn't he's not a scary guy, guys. Don't be afraid to reach out to Brian if you're 9 to 12 months out. I can't tell you how many clients are like, oh, I don't know. I don't want to talk to a lender yet. I want to talk to you. I want to look on Zillow. I want to kind of just feel it out. And I'm like, as much as I urge them to speak with a lender as an agent, sometimes I've pulled back and I'm like, I got to know when to push them and when not to push them to go to the lender. But I completely agree with you. The sooner you can speak with a lender, the more educated you are. Don't be afraid of the credit check. I can't tell you how many times we hear that. I don't want that again. I'm like, dude, don't worry about it. If you dip a couple points in 12 months, you're gonna make it. It's so I've gone.
The benefit of knowing where you are and how to manage your credit, not just for buying a house, but like in general for overall, financial credit health. It's worth the 1 to 3 points hit to have your credit checked by a lender who's going to get the most detailed credit report that there actually exists out there, to be able to really guide you well.
And correct me if I'm wrong. That costs Brian money too, right? To pull that credit report.
Yep.
So
yeah, we float that. Yep.
Yeah,
So that's a free service,
Yep.
it is. And
That's a good point. I love that actually.
well, and people forget about that. They think it's some credit. And I always tell them like that lender is coming out of their own pocket to help you. And it really is. That's what it's about. And, I talk to a lot of clients that are like, I'm just not ready yet, and that's what we hear a lot. But I urge you to speak with a lender and get out there, get aggressive. And that's going to help your agent as well.
Yep, for sure.
Start lining up houses. So you're not looking at a $600,000 house when in reality, maybe you could buy a 700 or an 800 or a little less, right? So I love that. Switching gears just a little bit on the lending side. I know we hear a lot of the times, people really kind of think about the economic climate when they're considering rates and purchasing and refining. And I know Robbie asked a great question regarding that. And I'm sure you get this question all the time, but where do you think rates are going? And I know you don't have a crystal ball, Brian. I know.
That's the magic line, right?
But the Federal Reserve, we know Jay Powell's already came out, right? The FOMC meeting is January 30th.
Yep.
To anyone that doesn't know, the Fed meets typically on, I think, a quarterly basis, and they discuss these things. So why don't you walk us through just kind of your opinion or your thoughts on that? And I don't expect a prediction. I mean, we'd love one, but what are your thoughts on that, Brian?
Well, first thing is I always tell people, if I knew where rates were going to go for sure, I would be a very wealthy futures trader, not a mortgage broker.
Yeah.
But it is my job as a mortgage broker to track it, to understand what's going on in the market so that I can properly advise my clients, of course. I think, and it's important to understand for your listeners to understand that the mortgage interest rates, long-term interest rates, don't directly track what the Fed is doing with the
federal funds rate.
Short-term federal funds rate.
And I had a question on that.
It absolutely impacts the way investors behave in the capital markets, in the mortgage-backed security markets, 100%. But it's an indirect effect. But that being said, we absolutely do expect that it will have a downward pressure effect on mortgage rates. How far they go, I don't know. I have concerns about affordability first and foremost. So we are seeing increased activity in the market right now. We're getting more and more applications actually, which is exciting. But nowhere near where we were a couple of years ago, right? Still in terms of our volume, but. I think that as an industry, we have to be a little bit patient to see what happens and not be out there, just talking head video after another, telling people it's the best possible time that they should buy. Rates are coming down. It might very well be. It's a depends answer. Should I buy a house right now? It depends. Do you have stable, a stable career path? Do you have the income to support the payment, regardless of what the rate is today? Is there a bunch of competition right now? Not really. Right? You can take your time and find the right house. Then yes, I would say definitely consider it, because owning your own home, owning real estate is so important for your overall financial health and wealth building. I mean, it's the same guy that has been renting a house for 30 years has nowhere near the wealth accumulation, generally speaking, statistically, than the homeowner.
I love that. And I think one thing too, just kind of going back to what you previously said about building in the margin, right? And I tell clients all the time, it's you're going to want to put money into the house, but there's also a level of reserve you need, right? Because one thing is survivability, right? God forbid the market does go down or the market goes up or what have you, you got to be able to survive the 30 years and not lose your house too. Sure. So I talk to a lot of people on that, and we're not the show that's always going to be like, hey, now is the best time to buy. So I really appreciate that answer. And it's always situation based, and I think it really boils down to you can always change things down the line, right? Sure. There's always a refi. You can always sell the house. Yes. I mean, there's a million different ways you can. There's
always an exit. Yeah.
Yeah. There's always an exit on that end. What are some misconceptions about the mortgage application process too? Just to kind of wrap this piece up regarding, applying. We're talking rates. Is there any scary things regarding a mortgage application that people should be aware of?
We don't require a DNA sample.
Okay.
I think the general public perception is that we ask for everything, including a DNA sample these days.
You ask for a lot of documents. I will
We
be.
do.
Yeah.
I mean, if you think about it, as a mortgage company, it's a business, right? And we have to be mindful of what our profit margins in so that we can stay in business and continue to service families with loans. And so, yes, we have to make sure that your income is durable, that it's there, that it's enough, that your credit is sufficient to demonstrate that you're going to be a good risk, that you're not going to necessarily default on your loan. And so, I don't think it's as painful as the public thinks it is before they go to get a mortgage. The right mortgage company has a really well-defined process that helps the people through it. And it's not just, here's an application, we'll let you know. It's, let's talk first about what your goals are. What is most important to you about buying a home right now? Why are you buying this house? Who is it going to benefit? Besides yourself, obviously. Now let's talk about your financial situation. How are you doing with your credit? Do you know where your credit is? Do you know how credit works? I can't tell you how many, especially younger people, don't know how credit works, and they're not getting educated at home. Unfortunately, I don't know why that is, but it's one of my passions is when I get to work with younger borrowers, because I was there.
Yeah.
It seems like it was just yesterday, but it was 21 years ago now that my wife and I bought our first
No,
house.
that's huge.
Crazy.
No, that's huge. And we're Young Money Mindset, right? We feel very, very passionate about helping, the younger generation, especially right now. There's not a whole lot of this, financial education happening, I feel like.
Yeah.
There's tons of it out there. It's just hard to get them to consume it, right?
It's hard to surface it in front of the right audience, And kind of going off of what you've been saying, I was curious your thought process on how you see the lower middle class and the middle class build long-term wealth through buying real estate traditionally. So, say you're not a guy that can afford a 25% down payment on an investment every couple of years. So how are you seeing people that are on a typical income? Are you seeing people do hey, let me buy a house every 2 years, fix it up, sell it, and transition and get my FHA? How are you seeing people grow through traditional lending?
Well, I think if we're talking about the next generation to start buying homes, first of all, did you know that the average age, I didn't even know this, the average age for household formation, which is when people typically buy their first house, they move out of mom and dad's house, is in the mid-30s.
Right. Yeah.
It's in the mid-30s.
I wouldn't have guessed that.
Wow.
Yeah,
I would have guessed lower, but I would imagine it's gone up significantly post-COVID.
Yeah, it's. I'm sure there's a lot of different reasons for it. Affordability is one, but it's not the only reason. There's societal reasons maybe that's going on, but and it's location, right? So certain areas are a lot harder to break into real estate. But I don't know. You have to start with your first property, your first primary residence. I think trying to get young people to just start investing in real estate as an investment is probably not that productive. I think because they're already struggling to get their mind around what does it even mean to own real estate to begin with. But like our story, like I was saying, like we had to make a conscious decision. So I tell people we've been lucky in real estate because we're on our third house. We're in our primary house, in our forever house. We went from $177,000 when we bought it originally to we sold it 2 years later. 3 years later in the summer of 2004 for $315,000.
It's not bad.
We had saved 20% for our next house, but by the time we sold that house, we had 20% in equity to roll into it.
Right.
Bought that house for about $4.5, and that was scary because now we're going from a $1,500 payment to about a $2,200 payment. It blew up. It expanded. It appreciated, and then 2009, 2008 came along and it crashed again. But 12 years later, we sold it at a profit to move into the house we live in now, and we thought we were buying high. In 2017, I'm like, honey, we're buying high, and we had to be made to move. It was like we weren't looking to move, but the house turned up. An agent, a really good agent that I was working with at the time, she had remembered that I told her a couple of years earlier that if the right house came up, we would move. And there it was, laundry list of things that had to be in place.
You're my favorite client, Brian.
I found this one just for you.
And I remember, like, honey, we're this is the house. It's almost 4,000 square feet. It's 5 bedrooms plus an office. It's on a cul-de-sac. It's half an acre. It's got giant backyard for our kids. We're going to do this, and we could do it without selling the previous house. But I remember thinking, man, we're buying high. We're buying high. And our rate at the time was about 4.5%. And we bought it for $629,000, and I could sell it for over $1 million today.
Yeah.
Very cool.
And so, people look at that and they go, "Oh, you just been lucky. You just timed it well." And I go, no, because you know what? Each time we made the decision to move, it was scary as hell. Okay. And we had to decide, nope, we're going to do this because we've done enough math. I'm a math guy. So I've done enough math to be okay with the risk. But at some point you have to be like, you got to trust your instinct that, no, this is a good move for my family. Dollars and cents aside, this is going to be a great investment for my family, not just the cost of it, or the affordability of it, but affordability is really important. But and I think that really applies today, because I think everybody's afraid of where home values are. They're afraid, especially younger folks, their younger families. They're like, yeah, I don't know. Is there a crash coming?
Yeah.
I don't know.
Well, it ties into the survivability. Yeah, I mean, but it ultimately goes back to survivability too,
Yeah.
because you never know, right? But like you said, you got to be able to take the risk and then also do the math and make sure
Calculated.
Calculated risk,
Yep.
but then make sure you can survive regardless of what happens. I think because there's a lot of people that, your story in '04 when you sold, and the house in '04 that you purchased was the same one that you sold and bought the new one in '17.
Correct.
So a lot of people in that '04, like, speaking just for my family, my parents bought, somewhere in that early 2000s era, but they never made it out of '08, right? They never had the ability to actually make it survive that and make it out and sell it. So it speaks volumes on your survivability and being able, because, you survived, came out, made a profit. Now you're into the new house, which now you have equity in that. So
And I will point out that we did not spend our equity as we've gone along.
You
So
weren't refi.
We've had that to roll over into additional real estate. We didn't go out and buy an Escalade with we didn't do a HELOC and then go buy a boat and
Yeah, exactly. Or refi. We see that a lot as well. On the investment side, kind of what Robbie was saying here. Do you own any rental properties currently?
We do. Okay. We have a it's an inheritance situation, but we are operating a monthly rental in Solera in the Lone Tree Golf Course, the Solera 55 plus, and that's been a lot of fun. Like, it's not, we could do a 12-month rental, just a long term, but I've always wanted to add a VRBO to our portfolio and saw this as an opportunity to do it. There's a huge snowbird market for communities like this. We've got it rented for these 4 months, and it's going to practically cover the entire nut for the year.
Wow.
And so that's been cool. Yeah. And we're very interested in expanding with a cabin that we would VRBO up in Flagstaff, for example.
Yeah.
I've been looking at one, actually, trying to get a cabin up that way.
Mm-hmm. Yeah. I dream of that as well, man. That would be awesome. How, as a lender, I'm curious to know how you would go about buying an investment property up north. I mean, would you be just, traditional 20-25% down and just doing it traditionally? Would you entertain any creative financing, any seller carrybacks? Would you hunt those types of opportunities out?
I think a seller carry could be very interesting. We're hearing a lot of very interesting seller carry offers coming through that are well below market rates, by the way. And so I'd absolutely be open to that. Incidentally, we can. I don't want to get off topic here, but we also can broker commercial loans. And I recently had a client prospect come my way who's looking to buy it's a fix and flip in Ahwatukee, and so he was exploring different financing options, and we have short-term construction financing that we can offer. But he ended up but our rate, the market rate right now is we were at 9.5%, 10%, something like that. And he ended up getting a seller carry offer at 3.5%.
Wow.
With 90% with 10% equity.
Yeah.
And right now, if you're seeking that kind of capital, it's minimum 25-30% equity and definitely not 3.5%.
Yeah.
So I would absolutely be open to. I would certainly look for carry situation because I think there could be really interesting ones. Depending on where rates are, I'd still prefer to put down as little as I possibly can to save as much capital as I can. And
Ding, ding, ding! Brian just hit the bell on the head,
Like,
guys.
I got
You heard it.
12%. I'll put 12% down. It's like,
Well, you heard it from a lender, right? Too. A lot of people think, man, I should be putting maybe 20. I should be saving up all this money and waiting and then purchasing. In reality, you want to try to keep that cash as well. There's a lot of value in keeping that cash, and I'm sure you advise clients depending on their situation. I've had clients come to me and they're like, Luke, I have $100,000 to put down. What should I do? And it can be tricky, because I always kind of relate it back to the Dave Ramsey method where, Dave Ramsey is an anti-debt, which is good for the masses, right? It's good for people. If you came to me and said, I got $100,000 to put down and I know you're my buddy, right? And I know you're going to go spend it all vacationing and clubbing, I might tell you like, hey man, as a friend, you should put the 100 into it, but it's maybe not the best financial decision.
I mean, the Ramsey mindset is good.
Yeah.
In general, he's got to sell books and advertising, and so being controversial and way over the top is how he does that. But yeah, I know. I again, you have to. Everybody's scenario is a little bit different. I think that you do the math on it. You do the return on your investment analysis on it. What's your capital appreciation rate on the deal? And most often, if you're able to minimize how much capital you put down, you end up better off anyway because you're able to do a lot more with that capital elsewhere than having to rather than putting it all into one.
it allows you to sustain the markets too,
Yeah.
I was curious too, kind of off topic. Obviously, you've got your VRBO. Do you do anything outside of your earned income as passive incomes?
Well, yeah. So I did a couple of things. So we have the rental property in Solara. We've actually, MyCityLender, the MyCity family of businesses has expanded. We've opened up MyCity office. I mentioned that to you. I think
you did
day.
mention it to me.
And
Yeah.
I'm going to give you grief because I haven't seen you at F45 in a while.
Going 2 days a week.
Robbie and I work out together.
Got him.
That's where we met him. I switched up. I'm doing 2 days a week back in the traditional. Gym.
Okay.
I was losing my size. I had to do something else.
Okay. Cool. So we've expanded into the co-working space, which is actually cool. We realized that there's a market for it, and we're able to network with a lot of other businesses while having others pay for our rent, which
really
turbocharges our profitability as a mortgage company.
Yeah, I'm really interested about that. Just to kind of unpack that because I've been looking into the whole WeWork situation and just how in turmoil that company is, and I just boggles my mind that
partied like rock stars.
Yes,
that was
Up while they could.
part of the problem, not the whole problem. But.
yeah, but I just I don't know if it was they went too wide too fast, mismanagement of capital. I'm sure you could attribute that to a lot of different factors. But I mean, from your research and from what you've done, you've identified a need for that. So
yeah.
I think that's really interesting. I mean, where are you thinking that because of just what you're able to get the space for is significantly below maybe what it was, 5 years ago,
right?
Because of the issues going on with commercial right now in general, and then you're able to kind of sublet those back out.
Well, yes, that's definitely our forward thinking. I mean, for starters, the space that we're using is we are absolutely cash flowing with the members that we will build out in there. We're not cash flowing today because we haven't completely filled it out, but once we do, it'll absolutely be a standalone revenue generator for us. So it's a private office, private executive suite, but it's co-working. So we can't really say executive suites because that suggests leasing and subleasing, but it's memberships. So it's totally turnkey for small businesses who are tired of working from home. We know that there's a demand for it. A lot of people went remote in the pandemic, and now they really don't want to be anymore. And so those are the people that are knocking on our door all the time to come take a look at it. Is like, hey, I need a space. I need an office. I want to be able to have meeting space. We've had a couple that they've got a podcast. We have a podcast studio. We're working on ours. We don't have we're at the point where we need to upgrade our cameras. That's where we've got all we've got the Shure SM7Bs and the Rodecaster recording and all that. But I think there's a real demand, for private offices because where one of the ways that I think WeWork failed is that they went with the fully open, everybody in one big space, sharing ideas, collaborating. It sounds awesome and sexy and like you think would definitely appeal to the younger crowd, the young entrepreneurs, and I think there's a part of it that would because who doesn't especially, the pandemic taught us that humans need to be interacting with each other. We're a species that need each other. We can't just be alone, locked in our room. I don't care who you are. If you tell me you love working at home,
Yeah, we'll see how long you love
there's
it.
Parts
for.
of
Yeah.
it. There's
Yeah.
parts of it. But so that was their model, was big open, and they would have, from my understanding, offices you could duck into, but you didn't really have a private dedicated space. And then they went after the most expensive real estate in the most expensive cities to launch this thing.
Flagship stuff.
I know,
Yeah.
look at the one in Texas.
Massively
It's ridiculous.
expensive leases and
Yeah.
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 And that
No,
kind of
that's interesting because I mean, I totally see it now. It's like, yeah, there's definitely, I can see a need for not that sexy, crazy, super high,
Yeah.
expensive type office building, but something just more, something that's nice, something that makes people feel welcome, but also not, over the top. And
So especially in areas like ours, right, where you're away from a city center here, and you have lots and lots of people working from home and small businesses that are getting started in their basements and their kitchens, but they really need a professional space to really keep it moving. And
what is a membership cost?
so we're at $1,200 a month for full-time membership on a 12 by 12 office. These are beautiful glass offices. And we're one of the ways we're trying to differentiate is to be all inclusive in our pricing. So it's $1,200 a month, and for that you get 4 hours in the conference room, you get a couple hours in the podcast, you get free reign of the shared space, you get unlimited coffee, 24-hour access without nickel and diming you.
And if, like, let's say someone that's got a team, right? If it's me and 5 other people, I mean, is that realistic to be able to be in that one space there, or I mean, is it
5 people, 12 by 12 might be a bit tough.
Feel a lot hot in there.
We can absolutely see, a team leader and then maybe an assistant sharing a space. That kind of thing for sure.
okay?
Yeah.
That makes sense, yeah. And then you obviously have access to all the other, amenities and community space over there.
Do you own that building over there?
No.
No. How long have you been in there?
In the building itself, we've been there probably about 15 years now.
Wow.
Yeah.
Very cool.
Yeah. In the space we're in now, about 4.5 years.
And My City Lending was born in 2002, was it?
My City. So it's MyCityLender 2.0 right now. So hats off to my partner Jay, who started MyCityLender originally. He's going to kill me. I don't know the date off my head. I think it was 1998, somewhere around there, late 90s, and he got it started, and it was a single office correspondent lender up to something like 30 employees doing millions and millions of dollars a year in revenue, Arizona, California operations, and then various market environmental forces brought MyCityLender 1.0 to an end. But really what it was is we were offered an opportunity to be the founding branch of Bay Equity Home Loans here in Arizona. And so we took that opportunity and that was actually 2 months after I joined him, by the way, in the business. I was a Wall Street recruiter before this. I owned a Wall Street search firm, and so I've been a commission entrepreneurial type guy all the way along. Co-owned that business before getting out of that. Ironically, I got into mortgage because I saw it as a much more stable living compared to what I was doing, which was placing mortgage-backed security quants at Bear Stearns and Lehman Brothers.
Wow. That's a
I was
trip.
in New York City the day Lehman went bust.
Wow.
And met one Lehman guy after another looking for a new job. It was so surreal.
Oh, I'm sure, yeah.
And that was before I knew Jay, and then I would subsequently meet Jay, and wait a minute, this is a job where I get to draw on my finance experience, I get to draw on my home ownership experience, I get to help families in my community, and I get to build business partnerships.
Yeah.
I'm in.
Yeah.
And
naturally.
And it at the time it seemed much more financially stable, and it has proven to be over time, but it's not always that way. It's still a commission gig, and we're still up and down, and we had a really, really rough year in 23. We did okay, but we're still here.
Yeah. No, I think a lot of businesses, I love the honesty and the transparency. I think a lot of businesses that are honest, that 2023 was an interesting year. I think it started off pretty decent for everyone, but towards the middle, Q3,
Got
Q4,
a little funky, yeah.
It did get a little funky. So, and 24 has been off. Obviously we're, no real time in 24 yet, but it's been a pretty good start, I would say, and we're super excited about the future in that. A couple other questions I had. I think there's a lot of misconceptions. There's going to be agents that listen to this that I don't really think even speaking for myself, I don't really understand the process from, let's say I go get a mortgage from you at MyCityLender.
Yep.
What happens with that mortgage? You guys don't hang on to it, right?
We do not.
Okay. So what happens, and unpack that for the agents in the audience listening when, you get a mortgage statement, 6 months after you buy your house, and you're like, wait a second, who am I paying now? What's going on with that?
So the first thing to understand is that the mortgage industry, the ability for our industry to exist, to be able to provide loans to families and investors, it exists because of the liquidity that's available from investors out there who buy these mortgages. Mortgages are bought and sold all the time. So even if you go to a credit union, for example, and they lend their own money, right? And so generally they're servicing their own loans. Eventually they could still sell. They still might sell your loan.
And they would do that for liquidity or risk, or there could be a variety of different reasons they would do that.
They have very smart people running black boxes and risk models and financial calculations on their portfolio, like you would analyze any other portfolio. If you're a real estate investor and you've got 25 residential properties, you're going to be analyzing that for when is it time to sell these homes and move on from it. It's the same thing with mortgages. So the investors out there that are buying mortgages are constantly looking at that kind of portfolio optimization. And so nobody's mortgage is ever safe in one place. That's the first thing to understand. As a broker, we actually are in the unique position of being able to, it is true. So before I became a broker, I thought, well, brokers love to say they can shop your thing right. It's absolutely true. And it's not being disingenuous to say that I can take your scenario and I can call 10 different investors and say, where are you guys at today on this? I have gotten a good feel for how they will treat different kinds of scenarios. So I know which ones we'll be able to get this done very, very quickly. I know which ones might wrench on a little bit longer, but maybe offer a little bit better rate. A broker is able to really identify that for you. When you go to a bank, you go to a big retail lender, they're really kind of captive. They've got one underwriting crew. They've got one secondary crew that is doing a lot of hedging in the background, but you get one rate, and you don't know where it's going to go from an investor standpoint.
And that would be a higher, correct me if I'm wrong, that would be a higher margin typically. That those people that are all in-house, right, are going to need to make more money than necessarily a broker in a sense that, because you would be able to shop it and you're going to make your fee regardless of which one of these lender or investors it goes to.
It's a lot more transparent, and the reality is brokers, we operate a lot more lean compared from an operations standpoint.
Okay.
Compared to large retail mortgage companies, for example. Banks are an entirely different galaxy.
By the way, banks are nightmare deals.
Yeah.
They are always nightmares.
We're totally transparent. I mean, we operate on we're under 3% on our company margin, and the retail companies out there, they're usually 4 or 5%, 400 or 500 basis points, and so they've got to pay. They've got layers of management. They've got the underwriting team. They've got in-house processing. They got all these different things that they have to pay for. Big space that they pay for, and so it just costs them more to operate their business. Not that they don't do it very well. We came from two different. We went from Bay Equity to People's Mortgage, and they're both great companies, run very, very well. Love the people there, but it's just a different model.
Yeah.
And we started MyCityLender because we wanted to have more freedom when it comes to the products we can offer, getting into more creative type financing and even commercial type financing, brokering that, and just being able to offer much better value to our customers and a much more transparent pricing process.
So your loan, right, guys? So if you're out there listening and you're like, why am I paying a different company now? Your lender, right, whoever gives you that mortgage can sell that to basically another investor and another investor. And that could be, there's an infinite loop on that, right? There's no, I mean, at a certain point, I would imagine it wouldn't make sense, or maybe it would, but just count on that, right? I mean, it doesn't change anything. It is kind of frustrating. It's kind of a pain in the ass. If you ask me, I gotta go. I was just pissed off because I gotta go set up auto pay again, and I'm like, come on, can you guys transfer that too or sell that?
Yeah, and we've been, personally, we've been bought and sold many times, right? But you have to, even though it should take care of itself, the insurance company should be alerted by the new mortgage servicer. Don't count on it. Call the insurance company, make sure they know, make sure it's, because you could end up with an insurance company saying we didn't get paid.
Yep.
It's interesting.
Yeah.
But,
or your impound account. Yeah, it's all jacked up.
But so when we do a loan, we're setting up the loan. We're doing all of the diligence to make sure that it's a good opportunity. We are working directly with the customers to make sure that it's the right loan for them, to help them understand the credit, to make sure it's a good, affordable situation for them. We take a holistic approach to it. It's not just an application. We'll let you know, as I was talking to him earlier. And then once the loan closes and funds, which the investor is doing, by the way, with us helping to manage the communication and everything, then the investor is the one who takes over the payments, and they collect everything.
Yep. And then it's up to them on when that's sold. So as promised, I know shifting gears a bit and going into the creative financing side and just kind of unpacking. I know we discussed a little bit about the seller carrybacks and how awesome those are.
Yep.
But really what I wanted to get into is the subject to type transaction, right? The idea of buying a house and keeping the mortgage in, let's say, for example, Robbie's name, and I own the house.
Yep.
Robbie's carrying the debt. I own the property. And what does that look like from a lender standpoint? Because, as we know, right, these mortgages are sold to a different, servicer. So that servicer is not going to be aware that, Robbie's house is not owned by Robbie, right? Even though they have a clause in there, and I'm sure you're going to educate us on the due on sale clause.
Yep.
And kind of what that means to that particular servicer. So go ahead and unpack that and kind of just riff on what that would look like from a servicer's standpoint.
So I think the word creative is a good one for this, because it is a very creative solution. It's kind of like reverse mortgage. It's a very good product for the right person, for the right situation. And it's typically kind of a bridge loan type of scenario, right? Where you're needing to. Are we doing a purchase scenario? Or are we doing a refi?
Purchase.
Okay, purchase. So so why do you use it if you're getting a purchase? It's because I want to buy this other house over here, but I need to sell this one first, and I'm not sure when that's going to sell, and so I've got equity in my house, and it's a way to use that equity to get into the next house, hopefully without it affecting your qualification for the next house. And I think that's where your question really goes
It is,
to.
but and a lot of people think automatically that that's it. But in reality, a lot of the sub-2 transactions happening are folks that have no equity in the house. So I get a call as an agent, right, and you want to sell your house, but unfortunately you bought it, maybe 2 months ago. Right. And, obviously the market hasn't appreciated that much, and you put maybe 3% down. So, you have no equity in the house and you call me to sell your house. And I'm like, hey, Brian, that's awesome. I'd love to sell your house. But, even if I reduce my fees, we still have to pay a buyer's agent. There's still closing costs to be paid. I mean, are you in a position to come out of pocket $10,000? And maybe they are, maybe they're not, right? And a lot of these folks are not. And that's where an investor will come in and say, hey, look, why not, instead of you putting, instead of you coming to the table with, this imaginary money that you do or do not have, why don't I give you $10,000 or $20,000 to go and rent a property, and I'll just take over, that existing loan. And when I say take over, I should clarify, meaning that we're going to own the property and the debt is going to stay in your name.
Yeah. So the only few that I've come across to date, they were people that were looking to buy another property, but you're talking about the people are just going to become renters.
Correct.
Yeah, most of these people just want to get out. They're moving states.
So my question is if you're the subject to company, where's the
value for us, right?
You're going to assign a certain interest rate to that 20 grand or whatever it is that you're giving them to go rent, and then how are those companies making the money?
So it's a great question.
That's my question.
Let me unpack one for you right now. So I'm buying a house right now in Coolidge, and the property, it's a conventional note. It's a 3.25% payment, 3.25% interest rate.
Yep.
The PITI payment is $652 a month.
Okay.
They have roughly about $25,000 in equity. By the time you pay agents, maybe that's 20 grand. So what I did is I said, hey, let me give you $25,000 cash. Let me pay all of your closing costs.
Okay.
And I'll go ahead and take over that 3.25 conventional note for 10 years. So the value in it for me is I'm going to go ahead and put a tenant in there. That tenant's going to pay me $1,250 a month.
Yep.
So I'm going to make that delta. Plus, to me, like we had mentioned earlier, is I cannot go find a lender to give me money at 3.25.
No.
So when I look at an amortization schedule, right at the end of 10 years, you know, the balance on it, the current balance on that property is $112,000. So at the end of 10 years, we all know that first, was it 5 to 10 years is really front loaded in interest. So we're going to pay a ton of interest, but we're also making a decent amount on that principal payment every month. So we're essentially banking or speculating that, hey, the market could appreciate. I feel confident in a 10-year horizon that the market is going to appreciate. And also I have my principal pay down and the PITI payment, since the interest rate is so low, that I feel pretty protected if the market were to ever go down. I'm going to be in a better position than an investor that just went and got a 6% rate, because I can, worst case scenario, I can really get aggressive on my rents if I needed to.
Yeah, well, and from your perspective, you put in 20 grand, and so what is the return on that investment? From,
Exactly.
you know, what
Cash on cash standpoint.
Yeah. And that seems like a pretty minimal investment to acquire a cash flowing
Asset.
asset.
Yeah. So, and that's really where we're seeing a lot of the sub 2 types of deals work out. And in this particular case, you know, these folks are selling in a market like Coolidge, and they're buying somewhere in the Midwest where houses are $100,000. You know, so that $20,000 is going to probably pay a year to 2 years in rent. You know, where they're at, and then they're going to be able to probably be in a a better financial position down the line, you know.
So your question for me is how do as a lender, how do we deal with that when it comes along?
Yes.
The short answer is, do I know about it? Did it show up on the credit report?
Well, when they go to buy, the mortgage is in their name.
Well, except that if well, that's what I'm saying, right? So if the assuming that the mortgage is still in their name, it's still going to show up on their credit report. The general rule is Fannie, Freddie, they will allow it, but it really comes down to the investor. It comes down to how the investor is going to read that situation. Is this a debt that we can exclude from the debt to income ratio or not? The general rule is 12 months. And before we got started, I was telling you, giving you kind of the sample of your parent buys you a car and is making all the payments, and you come to me and say, I want to qualify for a loan, and there's the loan for the auto for the car on your credit report. If I can demonstrate that your dad's been making the payment for 12 months, it's not coming from your account. We need 12 months of your bank statements to prove that the payment's not coming out of your account. Yeah, we can do that. We can totally do that. Real estate's a little different. Real property is different, because now you got titling, and you've got a lot of different issues that can pop up with that. So each investor is going to treat it differently. Some might say, I think the baseline is 3 months that we were talking about earlier. Most are probably going to look for at least 6 months before they would allow like a percentage drop, like we were talking about, a 75% exclusion.
Right.
But still, some are going to say, well, nope, we need 12 months, or there's no exclusion.
What if we're talking 2-3 years, right? What if we're talking, they're going to rent, most likely they're going to rent another year, and we're talking, end of 20, maybe 2028, they're going to be buying, 4 years from now. Like, how would it be viewed as from a lender's perspective?
I think at that point, I think you're beyond 12 months, and there's a clear track record of you not making the payment.
Yeah.
I think at that point it's a different story. It's just that within 12-month period that can get a little iffy. No loan officer can just promise you out of the gate that he's going to be able to find an investor that will take it in less than 12 months. Is my point.
Yeah.
So you got to be a bit careful with that. And again, as a broker, I can go to the source and find out for sure. Though I can talk to 5 different investors and go right to their underwriter, not just their account executives, who are awesome and they do a great job in helping us flesh out scenarios. But if you want the answer, you got to get to an underwriter, right? Because they know what's going to get approved and not. And so we have that ability as a broker to do that, and we absolutely will do that.
Well, and that's huge too, because if you're an investor out there and you're doing sub 2 deals right now, and a big objection we hear all the time is, oh, well, they're not going to be able to buy. Maybe they're just talking to the wrong lender. Maybe they're just maybe they're not talking to a broker.
Yeah.
And they don't have the access, to get directly to these underwriters, or to get really to someone that can shoot them.
I had a new build that we ended up selling sub 2, and he was able to buy a new build within the month of him selling sub 2.
Interesting. Okay.
Yeah, I want to say it was a D.R. Horton, out in Texas, actually. But all they needed to see, I don't remember, I think it wasn't a lease agreement. All they needed to see was the purchase agreement, the subject to purchase agreement, essentially saying that, hey, I am going to be paying these payments, and he was able to get approved. He's in the house now, and it all happened in a span of less than 30 days.
Yeah, that's interesting.
Yeah, I know new builds though. I mean, they can bend rules. They're pretty.
It depends. Some, as you know, some have fully in-house lending. Some, they're partnered with other mortgage companies in the community, that kind of thing.
Yeah.
It would have to be a super in-house situation.
Yeah. It must.
I mean, it's just like the the buy downs that builders are doing, which by the way, I mean, that's another thing that I love to talk about because I think it's highly misunderstood what a buy down is. And people think of it like it must be some kind of gimmick thing because it's coming up now where affordability and rates are up and all like this. It is not. It is bona fide dollars in the pocket of the buyer for the first couple of years. You have to know, of course, and if the loan officer doesn't point out that your rate today might be 5%, but it's going to be 7% in 2 years, that's a problem because now you are going to be shocked and be pissed off when 2 years goes by and all of a sudden your payment goes from $1,500 to $2,500 a month.
Are we getting into a situation, Brian? You obviously lived through the '08 crisis, right? I mean, what are we getting into a situation where these people are going to wake up in 2 years from now and be like, "Holy shit, my payment's going from this to that"? I mean, because from my understanding, that's what happened a lot back in '07, 06, '07, '08, right? There was some of that. Or the ninja loans, they called them, the no income, no assets, no job.
So
I mean, are we getting to?
It's not a ninja loan. It's not a subprime situation. Look, you want to buy this house. Rates are 7%, so you're not sure you want to buy this house. But I'm the builder now, and I'm saying you could buy this house at 5%. You're going to save $15,000, $20,000 over the next 2 years because of that reduced rate, and we're paying for it. The builder's paying for it. But look, the rate's 7%. Everybody else is paying 7%, by the way, who's buying without a buy down. Look at the 7% payment, Luke. That's the payment I want you to look at. Is that payment fit in your budget today?
Yeah.
Okay. That's the starting point. So if you're looking at that offer and you're like, yeah, the 5% fits in my budget, but the 7%, I don't know. No. Wave off.
And that's a 2-1 buy down, right?
Yeah, that's a 2-1 buy down. Okay. Yeah.
What about, but like the money, I don't know, maybe I'm just a skeptic at heart, but like I never think anything is ever for free, right? Like, and I talk to a lot of people where they're like, oh, we're offering as investors, we offer a free move, right? And I tell people like, that's just all baked into the price that we're giving you. So if I'm buying a brand new home at 5%, that builder has to be baking in that buy down into the purchase. So would they be able to take, if I said, okay, well, I'll go get my own lender.
They're just paying for it out of their money to get you to buy a house.
So they're just netting. They're
netting less on it.
How are you doing against these new build lenders? Are you able to beat them in any scenarios?
No, not when there's a buy down. No, because we don't have that same flexibility.
I mean, they buy them down millions of dollars at a time.
Yeah, they're right. They're big volume, and so there's some, and they've got all kinds of secondary market operations going on to hedge these bets that they're making and this cost that they're incurring. It's a real bona fide cost for the builders, and it's a real bona fide pickup for buyers. If I was a first-time home buyer right now, I would be going to the builders because you're not going to get a 5% deal on the secondary market. Maybe there's a seller carry, but that's
you got to dig for
matching
those.
the right house, the house you want to live in, and the chances are it's not going to be there, right? So yeah, they're spending the money to still be able to sell homes, and it's hitting their bottom line for sure, and it's also hitting the bottom line in a positive way for the buyers.
No, I think that's.
But again, 7%.
Yeah.
Is that payment okay for you right now?
No.
If you come into it going, yeah, I can handle that 7% right now, and this is the right house for me, 2 years from now, it's not going to shock you, and you're hopefully, because you're being intentional about it, you're going to plan for when that is. But also in the next 2 years, nobody can guarantee this. I don't have a crystal ball. But there's a good chance with the Fed's action, and they're going to ease rates and everything, the rates are going to come down, and you will be able to refinance at some point and manage that 7% payment. There's a good chance that payment doesn't exist 2 years from now because you'll be able to refinance.
And if on the inverse, if rates do not go down, and you pay for the 2-1 buy down, you're really saving money at the end of 2 years. I mean, essentially,
because you would have started at 7%. You would have been 7% day one.
But you're not getting the 2-1 for free, right?
Well, the buyer is.
Okay, I guess on a new build you are, right?
Yeah.
But if you're buying a resale house, like if I'm,
It's
representing,
a cost to the seller now, right? Because the seller has to pay for it. It's a seller concession that covers that.
yeah,
So it's still free to the buyer.
yep. Okay.
Well, I mean, it is.
it isn't. It isn't.
It depends
if
on.
it isn't,
It
yeah.
depends on how the purchase price of the house is being handled to maybe accommodate for a buy down amount. But
Yeah.
but the market kind of handles that, right? I mean, it's
Yeah.
a free market out there, and if
Yeah.
you can get it,
Yeah, take
know,
advantage of it. Yeah.
but maybe
No, I think that's And then just speak on, since we're on this topic right now with the whole 2-1 buy down. I've heard of the 3-1 buy down.
Yep.
I mean, is there a point, Brian, where it's like we're a 10-1 buy down and next
No.
thing you know, we're like,
How many can we
The
go?
answer is no. The answer is no because so a buy down is funded by a seller concession, whether it's a private seller or a builder. It's funded by seller concessions. Seller concessions are highly regulated by not the investors, but like Fannie and Freddie. You can use up to a 3% seller concession with a conventional loan. So the buy down amount can't exceed 3% of the purchase price. And so you have to, you got to do the math carefully, and you might not even end up at 3%. You might not even be able to do a 3% because it's the cost to cover that exceeds the total closing costs on the deal. That's another part of it. So there's the seller concessions can't be too high, and then there's the seller concession can never exceed the closing costs of the deal.
I didn't realize that.
yeah.
Really?
Yeah, that way, because I think in the reason where I've ran into this is people will try to inflate the purchase price and then try to show more in concessions, and the lender always kicks it back.
Yeah, to try to make the seller whole. Well,
See, I
yeah.
actually did that on my house and converted it to a buyer broker and took commission back out.
Well, that's
which-
because you're an agent,
Right, but
Yeah.
I had I think 4.5% concessions on it plus my
No way.
2.5% commission. So you know what? No. I did. I converted some of it for the seller to buy me an AC unit. So maybe that took out 12 grand. That's okay. That's why that worked out then.
Yeah, that wouldn't be on the closing cost side.
No,
I
because
think
it
is
wouldn't
what it
show
is,
it all
yeah.
to the underwriter.
Right.
Exactly. Yeah.
And you're obviously looking at these addendums, right? That we're sending you guys.
Yeah.
I was just asking
if we
because
if we get them.
I was like, yeah, I was gonna say.
If it
We
has,
don't always get 'em.
If
We-
it
we
has
don't-
an A or a 1 on it, we'll see.
Once in a while, we do have to
Sometimes we throw a letter on there, so it just goes to title.
No, that's funny. But yeah, I mean, I this has been super. I mean, I've learned a lot.
Yeah,
Brian.
I've been wanting to do this for a while. I had one more question for you. Obviously,
Fire
you've
away.
been in the industry for a long time. I'm curious what you look for in your realtor partners when leads come directly to you. And I was also curious if you had any horror stories. I'm sure you got a million of them. I'm curious if you had a good one that you'd like
Well,
to
everybody has horror stories. I prefer to focus on the positive side of things. I think that the best partnerships out there between lenders and real estate agents are where we understand what our lanes are, number one, and we work together to educate the customers and cross-promote each other and see each other as sort of equal partners in the deal. I think where it gets really tough and where you end up in the horror story land is when one side or the other sees ICU as just as a vendor, like just I'm serving the need here because I can get your loan done and get you paid.
Right.
You know, we're both on commission, right? We have the same exact goal in mind. We want to, and hopefully that goal is so to answer your question specifically, I want to work with an agent that sees the bigger benefit for the customer, sees what buying this house is going to do for them and their family. It's a commission for us, it's income for us, but it's just one commission for us. It's a home, it's an investment, it's a lifestyle, it's a life improver for the family, for the customer. And so that's what I try to look for in agents that I work with. Now, obviously we need to fill out our roster to be able to earn a good living. And yes, there are plenty of good stories out there.
Oh, God.
Yeah.
Yeah.
No, I really appreciate you guys staying tuned. If you made it this far in the podcast, I think there's been a lot of valuable information that we've all shared here, and I've definitely learned a lot. And it's been a pleasure to have you in studio today, Brian. And
Yeah, thanks for having me.
yeah, absolutely. And that's a wrap for Young Money Mindset. Thank you guys so much for following our podcast, staying up to date on what's going on, and if there's any questions or anything that you guys want want or any suggestions in terms of guests, we'd love to hear from you guys. I've been talking to Robbie about maybe bringing back our season 3 type feel where it's just us kind of BSing about the market, the political environment, what's going on just in general in the world as you guys, saw the podcast start off with. So thank you guys again, and we will catch you guys in the next episode.
See ya.